Welcome to today's video, where we uncover the retirement tax trap and show you how to find the right expert for a Roth conversion strategy. To set the stage, we will clarify why traditional professionals like CPAs and brokers excel in some areas but often fall short in multi-decade planning. Then, we will reveal who actually builds the plan you need, how to vet them, and how to coordinate execution without giving up control of your assets. Let's begin by outlining what we're going to cover. Here is today's roadmap. First, we will explore why standard CPAs and brokers, despite being valuable, typically do not deliver proactive, multi-decade Roth conversion planning. Next, we will identify the right expert, a strategic, fee-only certified financial planner who operates as a true fiduciary. After that, we will connect the moving parts, RMDs, Social Security, and annual conversion targets into one coherent plan. Then, we will point you to places to find advisors with flat fee or hourly arrangements. Finally, we will walk through a practical hiring checklist and test your understanding with short quizzes. With that, let's define the trap. The retirement tax trap is subtle. While calculating a Roth conversion up to the top of a current tax bracket is simple, the real challenge is designing a multi-decade plan that anticipates required minimum distributions, Social Security taxation, Medicare IRMAA thresholds, and future bracket changes. If you only optimize the current year, you can inadvertently trigger larger future RMDs and higher lifetime taxes. Therefore, the trap is focusing on simple calculations instead of a comprehensive strategy. Now let's clarify where common professionals fit and where they do not. CPAs shine in current year compliance, accuracy, and navigating estate settlements. They are indispensable for filing, record-keeping, and ensuring your taxes are correct. However, they often do not offer multi-decade scenario modeling that integrates Roth conversion sequencing with the timing of Social Security and long-term RMD mitigation. While they can easily compute how much conversion fits within a tax bracket this year, they typically do not construct a long-range strategy that reduces lifetime taxes. Consequently, you should seek strategy first and then use your CPA to implement and file. Next, we will compare advisors side by side. On the left side, we have traditional professionals. CPAs focus on compliance and accuracy, but typically do not build multi-decade Roth conversion strategies. Brokers and investment advisors manage assets and allocation, but rarely deliver integrated tax design across conversions, Social Security, and RMDs. On the right side is the strategic choice. A fee-only certified financial planner who acts as a fiduciary and is compensated via flat or hourly fees. This planner builds the comprehensive roadmap without requiring you to move your assets or purchase products, and then you can execute the plan with your custodian and CPA. With that context, let's visualize the decision flow. This flowchart illustrates the decision process. If you simply need a one-year bracket calculation, your CPA can compute it efficiently. However, if you need a multi-decade plan that sequences conversions, times Social Security, and mitigates future RMDs, then you should engage a fee-only CFP who will build that roadmap. The CFP coordinates the plan with your CPA for filing and with your custodian for execution, while your broker continues managing investments. Now, before we dive deeper, a brief but important disclaimer. This video is educational and does not constitute tax, legal, or investment advice. Everyone's financial situation is unique, and tax laws, RMD ages, and Medicare thresholds can change. You should consult your own qualified professionals before making decisions. With that established, let's distinguish simple Roth math from true strategy. While the arithmetic to keep a conversion within a specific bracket is straightforward, the strategic objective is to reduce lifetime taxes. That means shaping your pre-tax balances before RMDs begin, coordinating the timing of Social Security, staying mindful of Medicare IRMAA thresholds, and considering the surviving spouse's eventual filing status. When all these elements are integrated, the result is smoother taxable income, smaller required distributions, and increased tax diversification. Next, let's visualize a multi-decade timeline of actions. This timeline spans ages 60 through 95. Early retirement years often provide a window to perform larger Roth conversions, while ordinary income is relatively low. As you approach Medicare, you must monitor IRMAA thresholds to avoid unintended premium surcharges. Around the time you consider Social Security, coordinate claiming decisions with ongoing conversions. Under current law, RMDs begin at age 73, so prior conversions can help reduce future required distributions. Later in retirement, the plan addresses survivor tax brackets and estate goals. Annual tax projections and periodic policy reviews are built in to adapt to changes. Now, let's see how the team coordinates to execute the plan. This sequence diagram shows coordination across roles. You and the fee-only CFP collaborate to design the strategy, including annual conversion targets and Social Security timing. You then instruct your custodian to execute the conversions. Your CPA receives the 1099-R and handles accurate filing and safe harbor estimates. Finally, the CFP leads annual reviews to adjust for market movements, tax law updates, and life changes. With the process clear, let's list places to find the right advisors and how they charge. This table lists 4 useful directories. NAPFA emphasizes fee-only fiduciary planners. XY Planning Network offers many virtual, flat fee or retainer planners. The Garrett Planning Network specializes in hourly engagements, which can be ideal for project-based advice. The CFP board search lets you filter for certificates. However, compensation structures vary, so you must still confirm that a planner is truly fee-only and does not require asset transfers. Always clarify scope, deliverables, and pricing before you begin. Next, let's turn this into a step-by-step hiring process. To hire the right planner, begin by defining outcomes such as lower lifetime taxes and reduced RMDs. Next, shortlist 3 to 5 fee-only CFPs from credible directories. Screen for conflicts by confirming they do not require transferring assets and do not sell commissionable products. Request a written scope of work, including deliverables, timelines, and flat or hourly pricing. Ask to see anonymized sample outputs to verify multi-year tax modeling and RMD projections. Confirm that they will coordinate with your CPA and custodian. Finally, start with a project engagement and only expand the relationship if the value is clear. Now, let's equip you with screening questions. Use these questions to filter advisors. Confirm fee only. Always fiduciary status. Decline advisors who require asset transfers. Ask for clear pricing, flat, hourly, or retainer, and request an estimate for your project. Review sample plans that demonstrate multi-year Roth sequencing and RMD mitigation. Confirm their process for coordinating with your CPA and custodian. Finally, ask about planning assumptions for IRMAA thresholds, RMD start ages, and tax brackets to ensure rigor. With the vetting process in hand, let's illustrate conflicts using a simple chart. This pie chart highlights relative conflict risks. Asset under management models can create incentives to gather your accounts, which you may not need if you only want planning. Commission sales introduce product bias. Flat fee or hourly compensation aligns with a planning-only engagement. With conflicts clarified, let's test your understanding with a quick quiz. Question: who is best positioned to design a multi-decade Roth conversion strategy that integrates RMD mitigation and Social Security timing? Options: A broker focused on asset allocation. B, a CPA focused on current year filing. C, a fee-only CFP focused on fiduciary planning. D, a tax software tool. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, a fee-only CFP focused on fiduciary planning. This professional designs the multi-decade roadmap and coordinates with your CPA and custodian for execution and filing. Question: which fee structure most likely introduces conflicts for a planning-only engagement? Options: A, flat fee project priced upfront. B, hourly fee with detailed scopes. C, an AUM fee that requires transferring assets. D, a fixed retainer for ongoing planning. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, an AUM fee that requires transferring assets. That model can incentivize asset gathering, which is unnecessary when your objective is planning only. Flat fees, hourly fees, or transparent retainers are generally better aligned with a planning-only engagement. Here is a concise action checklist. Define your objectives, shortlist fee-only CFPs, and request a flat or hourly proposal with clear deliverables. Ask for sample outputs that demonstrate multi-year conversion sequencing and RMD mitigation. Keep your assets where they are, and instruct your custodian to execute conversions. Involve your CPA for tax filing and estimated payments. Review the plan annually and adjust for market changes and policy updates. As practical tips, track IRMAA thresholds and bracket creep each fall, and periodically reassess survivor brackets and estate objectives. Next, let's map all components visually. This mind map shows how the pieces fit together. Tax brackets and IRMAA thresholds inform annual conversion caps. RMDs start under current law at age 73, so projecting balances helps determine how much to convert earlier. Social Security claiming affects taxable income, while Medicare premiums respond to income 2 years prior. Investment considerations include asset location and tax liquidity. Estate planning involves beneficiary tax brackets and inherited IRA rules. Execution requires custodial conversions and quarterly tax estimates. Finally, risk management accounts for policy changes and market volatility. Now, to help you reach out confidently, here is a ready-to-use email template. Use this email template to contact fee-only planners. It communicates that you want a fiduciary planning engagement, not asset transfers or product sales. It requests clear pricing, sample outputs, collaboration details, and timelines. By setting expectations up front, you save time and attract advisors aligned with your goals. Now, let's consolidate the key points. These are the key takeaways. First, simple conversion math is not a substitute for strategy. Second, use the right professional for the right job. CPAs for filing, brokers for investing, and fee-only CFPs for the roadmap. Third, avoid compensation models that encourage asset gathering or product sales when you only want planning. Fourth, prioritize conversions before RMDs while coordinating Social Security and monitoring IRMAA. Fifth, keep your assets where they are and execute the plan independently. Finally, review annually and adjust for changes. As we wrap up, let's summarize and send you off with next steps. To conclude, hire a strategic, fee-only, certified financial planner to design your multi-year Roth conversion plan. Then, coordinate execution with your custodian and rely on your CPA for accurate filing and estimates. Keep your eye on lifetime tax reduction, not just this year's bracket. Vet advisors for conflicts and favor flat or hourly pricing. Finally, revisit the plan annually and after rule changes. Before we go, a quick creative request. Thanks for watching. If this was useful, please like the video, share it with a friend who is planning for retirement, and subscribe for more practical strategies. Drop your questions or experiences in the comments. What's your biggest challenge with Roth conversions and RMDs? I read every comment and may feature your question in a future video.